So good evening, ladies and gentlemen. Welcome to another episode of our knowledge series organized by PMS Bazaar. To introduce myself, I'm Pallavarajan and I'll be your host for the day. Today we have two guests from Abakkus investment team, Mr. Sunil Singhania and Mr. Aman. Welcome to both of you.
Thank you, Pallav, for having us.
Pleasure having you, sir.
Thanks, Pallav.
Pleasure having you, Mr. Aman. So before I hand over to the forum to Mr. Sunil and Mr. Aman, I would like to give a small introduction and try to set up a context for this webinar. So about Mr. Sunil Singhania, Mr. Sunil Singhania has over 25 years of experience. He is the founder of Abakkus Asset Management, established in 2018. Prior to this, he was a global head for equities at Reliance Capital Ltd. He oversaw equities assets and provided strategic inputs across Reliance Capital Group of companies, including asset management, insurance, AAF, and offshore assets. And as a CFA for equities, Singhania led Reliance Mutual Fund equity schemes. Reliance Growth Fund grew over 100 times in less than 22 years under Singhania's leadership. He is currently appointed on the IFRS Capital Market Advisory Committee. He was a promoter of the Association of NSE Members of India, a body of a stockbroker. He served on the global board of CFA Institute USA from 2013 to 2019 and as a chairman of the investment committee from 2017 to 2019. He also sat on CFA Institute Standard of Practice Council for 6 years and was the founder of the Indian Association of Investment Professionals, which is now CFA Society India, and served as its president for 8 years. He is a CA rank holder and CFA charterholder and graduate in commerce from the Mumbai University. Welcome again, Mr. Sunil.
Thank you.
And about Mr. Aman, Aman has over 17 years of Indian equity experience. Prior to joining Abakkus, he was the portfolio manager for all local and offshore schemes for PMS division of Reliance Asset Management. Having worked at Singapore office of Reliance, Aman brings along a regional and global perspective in investing, a strong track record across benchmark, absolute long and long short strategies. Before joining Reliance in 2005, he was associated as research analyst with TAIB Securities, Tata TD Waterhouse and other brokerage firms. Aman holds an MBA degree from Mumbai University. Welcome, Aman, again. So before I hand over to Mr. Sunil and before I hand over, the agenda for the day, Mr. Sunil Singhania will share his perspective on the equity market, followed by Mr. Aman who will be sharing Abakkus PMS strategies, followed by Q&A session. Over to you, Mr. Sunil and Mr. Aman.
Thank you, Pallav, for having us on this show, and thanks to all the participants for taking time out on a Friday evening and giving us an opportunity to share our views. It's always good to speak to all of you when the markets are positive, and we did start the day with a lot of concern, but all's well that ends well, and as has been the case over the last some time. The markets actually took the correction as an opportunity, and we ended significantly in the green. So as you rightly said, Pallav, I'll just take you through our view on the market, and then Aman can take over and explain the products about Abakkus and the products. So can we have the slides? Okay, so basically, coming to the markets, I think 2020 has been a very volatile year. I would say financial year 21. We started the year with a lot of concerns. In April, we were all worried about why we were invested in equity markets, and then towards the second half, we were all worried why we were not enough invested in equity markets. I think a lot of factors. What we are trying to do is just explain to you the 4 or 5 things which we believe are the near-term concerns for investors and what is our take. So obviously vaccines have come in, there is at least our view that the chances of a lockdown are very minimal. And all this has been discussed in significant detail. So as I was saying, the chances of COVID are a new lockdown is less, and we'll come to that. Global liquidity is again at a historic high. And it's not the only equity markets, but a function of dollar weakening has led to a lot of other assets have also seen good rallies. We also have some risk, and we will discuss that. Can we just have the next slide? So I was coming to that, So one is obviously there has been a massive liquidity. Once COVID hit us, I think central banks all over the world try to stimulate their respective economies, and the best way of doing it was obviously a lot of quantitative easing, pumping in the economy with a lot of stimulus. US alone has done almost $6-7 trillion of stimulus, and across the world we have seen central banks and government supporting their respective population by way of unprecedented quantitative easing. As a result of which, we are at a 60-year high in terms of money supply. And all this has meant that liquidity is in plenty. And it's not only liquidity, but it's also resulted in interest rates being at an all-time low level, notwithstanding the fact that recently there has been a little bit of uptick in interest rates, and we will come to that because that's been a major concern. Next slide. As we discussed, because of this high liquidity, the short-term rates have been at an unprecedented low levels. And I think this impacts positively in a multiple of reasons. So even in India, interest rates have been at an all-time low kind of a level. We have seen FD rates fall to 4.5–5%. The companies get benefit because companies are paying less interest. And what it also does is it stimulates a lot of demand. For example, if you are buying a residential house, your the loans have fallen below 7%, and therefore your EMIs are now down almost 20–25% than where they were maybe 1 year back. And same is the case with automobiles, for example. When you're buying a car or a two-wheeler, your EMIs have come down by 10–15% because lower interest rates. And I think these two are large sectors. They have a multiple impact. Steel, cement, building material, and a lot of other sectors have also started getting benefit because of both automobiles as well as the housing sector. Next slide. One interesting aspect of the last few years was that dollar was constantly appreciating. So if you see this move till almost 2000 and right from 2008 to 2020, dollar was continuously strengthening. And what was happening therefore is that money was moving out of emerging markets and all the other asset classes and going into US. And as a result of which, dollar kept on appreciating and bond yields kept on going down. What we are seeing now is a reverse. Last 6 months, dollar has decisively depreciated against the British pound, against the euro, against yen, against RMB, and or to the extent of almost 6–7%. And we are now in a scenario where dollar carry trade is very much on the cards, and it's already happening. And I think that is also one of the reasons why bond yields have inched up a little bit. So money which was all going into the US, and there is estimates that almost $10 trillion worth of additional flows went into the US economy over the last 10 years. I think that has reversed, and we are seeing therefore emerging markets attracting a lot of flows, commodities attracting a lot of flows, even new asset classes like blockchain and bitcoins attracting a lot of flows. So as long as the scenario for dollar continues to be stable to weak, we believe that this money flow into emerging markets and therefore India is going to continue. We discussed about COVID. I think these are interesting charts. If you see, we have given 4 countries, US, UK, and Israel. In all these countries, the orange line is the line where vaccination numbers have been represented, and the blue line is the the net daily cases. You see in these 3 countries, which have been very aggressive in terms of vaccination, the net cases have collapsed. In India, we are still slow. I think we have not even covered 3% of our total population, but the chart is very steep. With every increasing day, like yesterday we had almost 30 lakh new vaccinations. Our view is that cases should start to ease off. We have seen a spike in number of cases, but as vaccinations increase, as has been the case in US, UK, and Israel, our view is that the vaccines seem to be working. The efficacy rates are anywhere between 80 to 95%. And as the world starts to get more and more vaccinated, this concern about COVID should start to ebb. On the Indian front, I think economic activity is back on track. There is this Nomura, economy index, which is almost at 96% normalization. We see highway activity, IIP growth has inched up back to positive level. E-way bills are almost at 80-90% of normal, and GST collection has been over 1 lakh for the last 4 to 5 months in succession. Other important factors like PMI manufacturing is well above 50%, which is a level where, which denotes expansion. So across the board, economic activity is back on track. Yes, in March, again, there have been small lockdowns in some places. So we might see a slight dip. But I think eventually the thought is very clear that we are heading back to normalization. On the government front, I think things have been pretty robust. Last 5-6 years, we have seen some disappointment where government was not exactly walking the talk. But a few things which have helped. One is obviously the PLI scheme. The performance-linked incentive scheme. I think we should just combine this with the China plus one strategy, which we are seeing all over the world. What is this China plus one strategy? I think globally, countries and companies are getting a little bit hassled with the domination of China, and they all want to move partially to a second source. And though India is not obviously among the top 2-3 countries, but India is definitely in the top 5 countries in terms of getting benefited from sourcing away from China. This, along with the fact that government of India is also a little bit anti-China. We have already banned 250 apps, and across products, the government of India has anti-dumping duties, countervailing duties, and even import restrictions. Combine that with the new unique performance-linked incentive scheme for 10 sectors, of which electronics and chemicals have already started to see a move. Our view is that finally this Atmanirbhar, Make in India is for real, and that can be the next trigger as far as faster economic growth is concerned. In terms of other initiatives, even the government of India had massive fiscal stimulus during COVID times, and the attitude over the last 2-3 months has completely changed and become pro-growth. We saw a fabulous budget. It was a budget which led to a record rise in the markets in one day on a budget day. It also heralded very clearly both the finance minister and prime minister's resolve of targeting very high growth. Instead of divestment, we are not now talking about privatization. And the government and the prime minister has clearly said that the government is not in the business of doing business. And apart from 5-6 key strategic companies, they want to sell off everything and privatize everything. And I think the other thing is that even in banks, the statement has been very clear that except 4 or 5 banks, they would want to privatize most of the other public sector banks. I think 1 or 2 big bank privatization has the potential of further re-rating the markets, and I'm very sure that over the next 6-8 months we should look at that. Small reforms, I think labor reforms, even the farm bill, despite all the opposition, the government has persisted, and these are really good long-term revolutionary kind of bills. The major question which investors have is that markets are very expensive. We have covered that later, but I just want to highlight the fact that the earnings season has been blockbuster. So when we had COVID in March 2020, in April, when the analysts were forecasting their expectations for March 21, I think across the board, it was felt that corporate India would have an earnings degrowth of 25 to 50%. So, earnings will halve for majority of the companies. However, the June numbers came, we had an earnings degrowth of 25 to 30%. September, we had an earnings growth of 10 to 12%. But see December, I think it's been one of the best quarterly results in almost 12, 13 years. After 2008, we have not seen such a huge growth in corporate profit in one quarter. So on a slower sales growth, we have had a great EBITDA growth because companies have benefited from lower raw material cost as also lower cost. And because of interest cost coming down, as I explained to earlier, we have seen a massive increase in the PBT and PAT. Our expectation is that Q4 also should be pretty decent. We have sectors like metals and chemicals and banks which will do very well. Yes, there will be some sectors which will get a little bit negatively impacted because of raw material price increases. But overall, we expect that even in March, corporate profit can rise about 20%. So vis-a-vis financial year 21 profit degrowing by 25 to 50%, we are ending the year with in fact a profit growth in single digits. As we move forward, I think financial year 22, the expectation is of a 25% profit growth because last year we had the impact of COVID in the first 6 months, which hopefully will not be there. And FY23, we are again expecting a profit growth of 15%. And that would mean that markets are not as expensive as made out to be. And I'll touch that a little later. Next slide. So coming to the Nifty PE, on a trailing basis, now the PE is upwards of 22, 23 times on a FY22 basis. On a trailing basis, it's more than 30 times. However, on a trailing basis, we have the impact of 2 quarters, which is March and June, where profits degrew, and that is optically leading to a PE which is showing higher. But as I mentioned earlier, as the results of March 21 and March 22 get discounted, we are looking at a PE multiple of 18 times FY23. And though it is 10% higher than the 10-year average, last 10-year average, given the huge fall in interest rates, our view is that structurally the PE multiple of 18 times seems to be the new normal. And we would say that markets are not cheap, but they are not expensive either. And there is decent money to be made at these levels. If you just combine the Nifty PE and see the 10-year GSEC yield, this is what I was actually adhering to, that on a comparison with the GSEC yields, the lower the GSEC yields, the higher is the PE, and that is clearly reflected. And that again gives us a lot of confidence that this PE multiple is sustainable. Another aspect of this market has been the move again to the broader markets. If you remember, 2016-17 to 2020 was a period where only 7, 8, 10 companies were performing, and that also on the large cap side, and it was basically quality getting more and more expensive. In fact, we wrote a note highlighting that there was a bubble in quality, and we should move away from the so-called very high PE names with very low growth to the broader markets where the investors were completely ignoring. So 2018 and 19, whereas the large caps did not fall, in fact they rose, and small and mid caps got butchered, things are already changing. So 2020, mid and small caps started to slightly outperform the large cap, but 21 in the first 2.5 months, very clearly small and mid caps have outperformed the large caps. Our view is that given their cheaper valuation and also faster profit growth, money is to be made in the mid and small cap vis-a-vis large cap. And we would continue to believe that the next 3 years, the broader markets and buying good growth companies at reasonable valuation is going to be the way forward. So very clearly, our view is that mid cap and small caps would outperform. What are the risks? I think the view is that obviously interest rates are going to be low forever. At some point of time, interest rates will have to increase. There is still time for that. We don't see that happening immediately. In fact, US Fed Chief Mr. Powell also said till 2023 interest rates are likely to remain zero. Therefore, though we should keep this at the back of the mind, it is not a risk which is very, very immediate. Commodity prices might impact a few sectors in terms of their profitability, but the good thing about India is that we are a very diversified economy. So, some companies get negatively impacted by high commodity price, but there are enough companies which get also positively impacted by high commodity price. So overall, as a whole, corporate profitability should have no major impact because of rising commodity. But if inflation were to shoot up, sharply, which again is not a view which we have, then, there will be definitely sentimental impact. In terms of COVID, there is a new wave emerging. Today, we saw and heard Maharashtra, bureaucrats announcing some restrictions. I think an extended restriction or an extended phase of restriction can again lead to some slowdown in some sectors, and we should be aware of it. There is a very small probability of a global trade war or a currency war emerging. Right now doesn't seem to be the case. And in fact, any trade war at the margin also positively impacts India because, as I said earlier, this China plus one strategy is something which ultimately is going to benefit India. So I think in summary, what I can say is that, we are in a phase where markets have come out very strongly out of the COVID-related, challenges. We are looking at the markets which are not very cheap, which are not very expensive, but broader markets from a time-to-time basis, we have big impact. One last thing which people are worried about, the taper tantrum. This keeps on causing concerns in the market. In fact, the morning correction today, sharp correction, was largely because of fears of the US yields shooting up beyond 1.7% and thoughts of taper tantrum. One is, the taper tantrum which happened in 2013 and which gave lead to this term called taper tantrum, and which no one was aware till 15 days back, and now we all know about it. Was 5 years after the fiscal stimulus. This time we are still in the midst of fiscal stimulus. In fact, only a few days back, the US government announced a further $1.9 trillion of a package. So our view is that this yield rise up from 0.6, 0.7% to 1.6 is, in fact, if you see the yellow line, just coming back to the pre-COVID levels. So if all the asset classes have come back to the pre-COVID levels, even the US yields coming back to pre-COVID levels should not be something which is to be scared about. Yes, if these yields keep on rising very rapidly, then you might have a little bit of a concern. But our view is that this should stabilize, and we should not see major concern about it. From a market perspective, therefore, we remain quite optimistic. Our view is that post the month end, we will see interest returning back. Already foreign interest is very, very strong. On a daily basis, we are seeing a lot of buying. We have this month a combination of a lot of secondary market blocks as well as IPOs come in. And therefore, a lot of money which otherwise would have gone into the secondary market is going into these blocks. And therefore, there's a little bit of liquidity crunch. And anyway, the last month is a little slow month. Come April, as the earnings season starts and as normalcy starts to return, our view is that you will start to see more strength as far as the markets are concerned. In fact, our view would be any correction would be short and swift, 7-8% correction, which is again what we saw this time also from 15,300, Nifty fell to 14,300 in the morning today, but will recover also very fast. From an equity return perspective, one is we believe that equity as an asset class will be the best asset class. In large caps, we expect returns to be around 8 to 10% on a CAGR basis. in the broader market, which is mid and small cap, our expectation is that return can be anywhere between 13, 14 to 18% over a 3-4 years perspective. Volatility is here to stay because we are still out of the very uncertain environment, but I would say use volatility as your friend rather than get scared with it. So to end on the market side, I would say continue to be positive and returns will be made. I now hand over to Aman to take you through the next part, which is a little bit on Abakkus and our products. Thank you.
Sure. Thanks, Sunil, and good evening, everyone. I'll be taking you through the investment philosophy and the funds that we have at Abakkus. As we are aware, Abakkus is now more than 2 years old company, and we have 2 live AI funds and 2 PMS strategies with us. All the investments that we do follow a very stringent investment philosophy that we have, which is something that we are pretty excited and proud about, and we have been following it since inception. The first and the foremost thing that we look into a company or in our investment is that we are alpha generators. We are not asset allocators. We are not investing into any company or any sector just for allocation. We don't look at underweights, overweights. For us, each and every individual stock is bought with the intention of making an absolute return. We may or may not, that's a separate thing, and that only the future will tell. But at the time of investing, we have a very clear view that we need to generate alpha after this investment. Whether we follow value investing or growth investing or a combination, the idea remains the same, that we need to seek alpha from our investments. We are a purely fundamentals driven firm. We don't indulge into any trading, any technicals, derivatives, nothing like that. Pure bottoms up investment approach. We have a team strength of 10 people here, which is a fairly large team for the size that we currently have. And the reason for that is we do lots of primary research. So almost 30% of the stocks in the portfolios would be stocks where there is no broker coverage. And these are companies where we have met before investing. We have done our groundwork, and for that, we need a large team support, which currently we have. So any investments that we do is purely bottoms up with a clear intention that there needs to be some triggers, there needs to be some growth opportunities for us, which will be realized during the investment phase, which is basically between 1 to 3 years. We follow a very independent thought process. We don't get carried away by market views or what's going around within the peer groups. We are very clear as to what companies we have bought and the reasons for which we have bought, and we are happy to follow our views until proven wrong. Being a small team as well as a small fund compared to what I and Sunil used to be at Reliance Mutual Fund, we are quite agile and flexible in our approach, and that's one of the big benefits of having an AIF and a PMS platform versus a mutual fund, where there is a daily NAV pressure and daily liquidity to be managed. Here in the AIF and the PMS format, we are quite flexible in our investment approach. We don't have sector restrictions or SEBI restrictions to follow. We do have our internal risk matrices, like we don't have single stock exposure exceeding 10% or single sector exposure exceeding 25%. But besides that, we are quite flexible in our stock picking as well as moving around between stocks and sectors. We are also not constrained to a very particular theme or a style. If something is fitting our investment framework, then we are happy to consider that. We are also happy to be quite contrarian. At least 10 to 15% of the portfolio, you'll see that stocks are something which is unique to us, and the market perception or the market view on these stocks could be different, or the market timing would be different. Stocks like sectors like sugar, paper, industrials, metals, these are some of the sectors where there's a time when markets were not looking into them, and we were the ones who had invested in them. And we are happy to consider investment opportunities like this even in the future. It doesn't matter to us whether the market is excited or no. For us, what matters is the risk-reward equation. If we feel the risk that we are taking justifies the potential reward that we are looking at, which should be disproportionately higher than the risk that we are taking, then we are happy to look into that opportunity. And we are quite patient investors, because the investment horizon for us is between 1 to 3 years at least. So we are happy to be contagious and hold on to our investment ideas till we see the potential returns in them. And ultimately, everything boils down to the risk reward equation. Any equity presentation globally, you see, people will always say that we want to invest in the great company at a great price. But practically speaking, that doesn't happen. If the company is great, then most of the times the price is not great. So you have to strike a balance somewhere. And this is what we refer to the risk reward equation. What is the risk that I'm taking for the returns that I'm expecting from the company? If the company is growing at 10, 15, 20%, paying a 70, 80 multiple for that kind of growth doesn't justify the risk reward equation in our terms. And we are happy to pass on to those ideas and look for companies where the risk reward equation is favorable towards us. And that is something that we follow very rigorously across all our schemes. Coming to the investment framework that we have created, it's very simple framework that we follow. We call it the MEETS framework. And the MEETS stands for first M is for the management. Clearly, India is an entrepreneur-driven company, and with 50% of the float owned by promoters, you need to be aligned with the promoter interest, and that is what we look at the companies that we have invested into. Capable management, management with hunger for growth, management who are fair to manage to shareholders is something that clearly comes first into the investment process that we follow. Earnings. For us, this is the second most important criteria. Whether we follow value investing or a combination, earnings is something which is core to our portfolios, core to our DNA, you can say that. Pure value also has no meaning unless there's some event or there's some trigger or there's some earnings growth into it. So while we always look at risk reward equation, within that there should be an earnings growth for us to ultimately invest into that company. By earnings, it's not simple earnings growth. I'll buy the best performing or the best growth companies. It has to be a fine balance of current earnings versus expected earnings, whether the earnings are cyclical or structural, and also what is the sustainability and the quality of earnings. The third thing that we look at is events and trends. It's an open market these days, and there's a plethora of information through various sources that we get, and just following fundamentals of earnings will not give you the desired results. There has to be some event or there has to be some trigger for you to get that additional alpha from your investment. And we are always in the lookout for such opportunities. Timing, as I mentioned, timing is equally important. But timing, I don't mean trying to time the market, but getting the stock at the right time or at the right phase of its investment horizon. Every company goes through phases, ups and downs and flat times, and it could be due to internal issues, it could be due to macro events, it could be due to structural events, government policies, and lots of other things. We would like to invest in a company which is either seeing improvement in its own fundamentals, or the sector fundamentals are improving, or the balance sheet is improving. There's something which is acting as a trigger, and we would like to invest at least 6 to 9 months ahead of that event to happen. If we invest too closer, then we will not get the right price. If we invest too early, then it's going to be a very long wait period for us. So somewhere we have to strike the balance, and that's what we try to do in most of our investment ideas that we have invested into. And the last thing is structure. There are lots of structural opportunities in India. Being an emerging economy, we all know the consumer story, the pharma story, the tech companies where we have steady, consistent, secular growth coming in, and these companies have steadily delivered returns. Obviously, valuation for them currently is higher than what we would ideally want to invest into, but at the same time, we are constantly on the lookout of structural growth opportunities. If we are able to pinpoint them at the right levels or at the right prices, then definitely we would like to consider those also into our portfolio. So that's broadly the MEETS framework that we follow for all our schemes. Now I'll just take you through the performance and the scheme highlights of the AIF as well as the PMS that we handle. So currently we have two AIFs which are now closed for subscriptions. The first AIF was Abakkus Growth Fund, which was launched more than 2 years back. It's a multi-cap fund. Almost 40 to 50% is large cap exposure. The balance is a combination of mid and small cap, with small caps being less than 10%. So 90% of the fund is between large and larger mid caps, I would say. We have a decent track record. Since inception, this fund has delivered returns of 21% CAGR, which is almost double the benchmarks. And the reason we feel this kind of returns were possible is because it's come as a combination of both earnings growth as well as P re-rating. Any investor looking into an equity exposure for the first time, or looking as an equity as an asset class, and is a very conservative to a medium conservative guy, this is the product for them. The second AIF that we have is Abakkus Emerging Opportunities. Now, this is a mid and a small cap fund. Almost 50 to 60% would be mid cap, and the balance would be small caps. We invest across small, it could be less than 1,000 crores market cap, all the way up to 7,000-8,000 crores market cap. On an average, the market cap for the company that we invest would be closer to 5,000 crores. Here, the idea is very clear, is to generate wealth over a 3 to 4 year period. We understand mid-cap investing due to the cycles that we have seen, and based on that, we understand the volatility in mid-cap companies, both from the market as well as in their own growth path these companies face. And for this reason, we, along with the MEETS framework, we have an additional framework for the mid-cap investing, which we call as the 15-15-15 rule. Now, what this rule is all about, I'll just share the details in 2 minutes. As I mentioned, any equity presentation you see, they will say that we would like to invest into a great company at a great price, but practically it doesn't happen. So if somebody has to give money to us, how will we deploy it? Or at the current level, what are the returns, or what are the kind of potential that we are seeing in this company? We follow this 15-15 rule. The rule is very simple. What it says is that at the time of investing, the company should be having at least 15% earnings growth. As I mentioned, earnings growth is something that is primarily important to us. And if there's earnings, if we don't see the potential of a 15% earnings growth, we would like to skip that investment. The second thing is the ROE of the company should be at least 15%. Now, this directly or indirectly takes care of all your other ratios, which is your margins, your moat, your debt equity ratio, leverage, and stuff like that. If you're generating ROE, which is 2x of the cost of debt, then you're running a very decent business with a decent profitability, and hence directly or indirectly, it takes care of most of the other ratios that we would like to consider. And the third thing is that the forward P of the stock should be less than 50. Now, obviously, if all these three criteria have been met, then it's a great stock to be in, great company, great ROE, and a great P. But as I mentioned, practically it doesn't happen. And hence, what we are saying that at the time of investing, at least two of the three criteria should be met. And the third criteria, which has not been met, should at least be visible. If it is not visible, then the whole ethos of the fund is lost. Good company, good ROE, but trading at 80 multiple, and for the next 5 years, I won't see a multiple, PE multiple less than 15, then it will follow the criteria of 2 out of 3, but the ethos of the fund will be lost. So if it is ROE, PE, or growth, if it is not being met today, at least over the next 12 to 18 months, it should be visible that the ROE will move beyond 15, or the PE ratio, because of the growth, will fall below 50. So this is the simple rule that we follow. It has helped us immensely over the last 1 year, both in weathering the volatility of March when the markets crashed, from the lows to where we are today, where markets are more than doubled, and we have seen a much healthier return profile from this portfolio. As I was mentioning, the key reason for this outperformance that you see, where in both this fund, has been both a combination of earnings as well as PE re-rating. Even for the June 20 quarter, which saw the maximum impact of lockdown, we had an earnings growth in both our funds, and it was a strong double-digit earnings growth. This followed in the subsequent September quarter also, and in the December quarter also. And for the current March quarter, we are seeing a much higher number, obviously, because the last year's base is low. So even during lockdown phase, the portfolio on an aggregate level has a strong earnings growth, and that helped us generated returns much higher than what the market was, because markets rewarded these companies. When growth was a challenge due to lockdown, these companies were outperforming the markets and the peer group, and that helped us immensely. And this is something that we would continue to look at even from current levels. Since both these AIFs are currently closed for subscriptions, over the last 2 months, we have launched two PMS schemes which broadly mirror both these AIFs. So one is a large cap PMS, we call it all cap, same 60 to 70% large caps, and the balance will be larger mid caps and very small proportion of small caps, that too if required. And the other one is the mid and small cap PMS, where predominantly the investment in into mid and small cap companies. These are just 2 month old schemes, and we are just building size and scale in them. Yeah, and this is the returns that we have generated over the last 2 to 3 months in this approach. The broad difference between the AIF and the PMS is that while the strategy is the same, the AIF are more broad based. They will be 30-35 stocks to even 40 stocks in at some point of time. On the PMS side, we would like to restrict investments around the 30 stock level. So it's slightly more concentrated than what the AIF is. At the same time, it's fairly diversified. We don't believe in too much concentration. We will not have a 5 stock and a 10 stock portfolio. Especially for mid caps, we believe diversification makes more sense. And clearly, the mid cap portfolio will be a 35 stock portfolio, both on the AIF as well as on the PMS front. So that's broadly these funds philosophy and the schemes that we currently manage and their performance. I would like to stop here. I presume you will have lots of queries both on the markets as well as on the funds. Happy to answer that.
Thank you, Mr. Aman, and thanks to Mr. Sunil as well. Thanks for your insights. I heard that Mr. Sunil is finding it difficult to rejoin. Hopefully, he should join in a couple of minutes. We'll move on to Q&A session. Perhaps Mr. Sunil has covered most of the questions which we have collated. He spoke about the markets, the taper tantrum, inflation, valuations, PE, where to invest. I mean, large, mid, small cap. And he also mentioned about, any correction would be short and swift and recover fast. And equity is the best asset class. And finally, he also mentioned volatility is a good friend. So with that takeaway, we'll move on to Q&A session. I'll try to take questions from the forum. So, Mr. Aman, since you are offering both AIF as well as the PMS, of course, you mentioned that AIF has been closed. Would like to know, is there any overlap between this AIF and PMS product?
Yeah, almost 40 to 50% of the fund is common, and the reason the other fund, the other balance 50% is not common is because AIF was launched 2 years back, and the market scenario and the market prices and the opportunities at that point of time was significantly different than what we are seeing today. So while the company that we have invested, they would all appreciate it, and we still see potential in them. But at current juncture, the risk reward equation might not be that great for a new investor coming in, and that is the reason we are looking at new opportunities and new investment ideas in the PMS. So broadly, 50 to 60% of the fund is common between the AIF and the PMS, and the rest would be different. And since there's also one major difference here right now is because since PMS is a new product, it's a new offering, and the AUM corpus there is small, we can look at stocks where liquidity is concerned. So we don't want to compromise on the liquidity. So right now, since the corpus is smaller, we can also look at stocks where liquidity is not that great, but good enough to fall into our criteria.
Fine, Aman. So you're offering two funds. One is, flexi cap or all cap fund, and other one is small and mid cap. So how should investor choose among these funds? Let's say if somebody is having only 50 lakhs as a PMS allocation, so which fund they have to choose?
So this is best answered as an asset allocation call for the investor. He has to get his own risk assessment done before investing. For us, the all cap portfolio is for somebody who is looking at equity as an asset class, maybe for the first time or is increasing his equity exposure. and it's going to be significantly less volatile than a mid and a small cap fund. Obviously, we all know the mid and small cap cycle in India. While they offer a better return opportunity, they are more volatile than the large caps. So, if somebody who has some past experience of equity investing, has some exposure to direct equity or through a mutual fund or through the PMS into large cap, then for them, this is a very ideal product to diversify and to add a mid cap flavor into the portfolio. At the same time, somebody looking at aggressive returns than the large cap, obviously the mid and small cap is what they should consider. So for us, between these two strategies, we are covering almost 90% of the market opportunities. Now it is up to the investor as to what his own risk reward equation, what is his own risk assessment. Based on that, he should choose either of the funds.
Thank you, Aman. See, there are a couple of questions which is in line with the exit strategy. So many of them are interested to know what would be your exit strategy.
So we don't have a watertight cast in stone exit strategy. The exit strategy is simple. It is two front. One, the investments that we do is with a 1 to 3 year investment horizon. During this period, if the investment view that we had formed at the time of investing changes, it could be due to company underperforming, it could be due to macro issues, it could be due to government policies, it could be due to global issues, it could be anything. If the investment thesis based on which we had invested changes, then obviously we have to had a relook at the stock, and then we'll take an appropriate decision. At that point of time, we'll not look at the price, whether we are making profit or loss or what is the percentage. If the viewers change, we would like to exit a stock and move that money into a new name or into a better investment opportunity and make the money at work. So that is clearly what we end up doing. That's the exit strategy. The second thing is the stock has moved too fast and too ahead than what we thought. And then for us, it's a switch opportunity. The returns that we were expecting in 3 years, for some reason, if you get in 1 year and the stock starts looking expensive, then it makes sense to sell that and buy another stock in the same sector, in another sector, where the risk equation is favorable. So it's a constant monitoring process for us. And either of these two scenarios would trigger an exit. As I mentioned, we are purely fundamentals driven firm, so we don't trade. So we would not sell something just because it has moved up in a week or in a month's time. So that's not an exit for us. We clearly buy with a minimum 1 year investment horizon. But if returns are faster or there's a change in view, we would like to exit.
Okay. So again, it's a collective question. Would like to understand your churn ratio, maybe for the past and also anticipation in the future as well.
So right now the churn, last 2 years in the AIF, what happened was that we were in the investment mode because we were collecting fresh funds and the fund was in the deployment mode. Once the fund is fully deployed, the churn ratio is less than 20% in the AIF, and we expect this similar churn ratio for the PMS also. So the risk of repeating myself, we are fundamental driven company with a 1 to 3 investment horizon, and that's the reason we don't expect a higher churn ratio than 20%, which has been in the past.
Fine, Aman. See, Aman, I think this question would be out for Mr. Sunil. Since he has not joined, I thought I can throw this to you,
Sure.
Being a colleague of Sunil. So how has your investment philosophy changed from the time when you were managing mutual fund money to now PMS and AF money? Also, Mr. Sunil has given 100 times return in 22 years period under the product, mutual funds. Will you be able to give the similar return, maybe less than 22 years in this PMS and AF as a product?
Sure. Yeah, so it's more appropriate for Sunil, definitely, but I've spent almost 13 years with him in Reliance with him, and I've also gone through the same process under him. See, the big difference between a mutual fund and an AIF is that there is no daily liquidity issue that we have to manage. So we can take investment bets over a 1 to 3 year period and not worry about near-term performance and not worry about peer competition. So based on that, the investment style has changed for us. So there, it's a daily decisions that you have to take for some stock to exit, some stock to enter, which is not the case here. So here we are doing investing in the real sense. In mutual fund, if you're running a very big mutual fund, then ultimately it becomes like more of a cash management than investing. This is something that we were not enjoying in a very large format, and that is the reason Sunil decided that it makes sense to quit the MF format and get into the AIF and the PMS format. So that's one of the very big difference, that your daily pressure on you is not there, and that gives them very big leeway to do investing the way you do it. Second thing is there's always some commercial consideration on a mutual fund platform, and that is not here. Here we can play to our strength. We can take decisions based, and we can have strategies based on our strength, and that is what we intend to do at the Abakkus platform. As far as the returns are concerned, obviously the 100-time returns were at a different market level. It was at a different market cycle. It was a different cycle for the GDP of India as a whole. And we can't predict what the future returns are. But all we can say is that those investments were done in the past. Today we are more experienced. We are more. We have seen more market cycles. We have interacted with more management than before. We have seen more market than before, and hence all that cumulatively should help us deliver returns which were better than in the past. But in the end, ultimately, market returns are the function of both earnings growth, where the GDP of the cycle is, and where the market cycle is. So very difficult to give a number, and obviously we can't give a number because it's not in our hand. But clearly, we are more mature today than what we was in the past, and that's what should ultimately get reflected in the performance.
Thank you, Mr. Aman. Mr. Aman and Mr. Sunil, and to the entire Abakkus team, thanks for your time, for sharing your insights. And participant, there are a couple of questions which is in line with the fee structure and the portfolio side and so on. Would request you to be in touch with PMS Bazaar team. You can write to info@pmsbazaar.com. Whichever question is not been addressed, we'll try to collate those questions and send across to Abakkus team, and we will come back to you in a week's time. So thank you, Aman, and thank you, Sunil, again. Thanks, participants. Have a great weekend.